Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent speech given by Jerome Powell and the effects that it could have on risk assets. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, my apologies for not making this video a couple days ago. I was going to make it, and then I was the first of the month, basically, or leading into it. And I always do the Bitcoin, the Beauty of Mathematics series then. So I just decided to put this off. But I did want to provide some thoughts on the speech by Jerome Powell and potentially some of the changes in how he has come across to investors. All right. So the first thing I'll say is that he very quickly reiterated what he has said many times. And just to provide a few quotes, some of the quotes that he says this like every single time he talks. Inflation remains far too high. Without price stability, the economy does not work for anyone. It will take substantially more evidence to get comfort that inflation is actually declining. The truth is that the path ahead for inflation remains highly uncertain, and we need to raise interest rates to levels to bring inflation to 2%. And he goes on, right? I mean, and these are the general types of comments that he's made for basically the entire year. And no matter what people say about, they'll just change it to 3 or 4%, Powell has reiterated time and time again that they will go as long as they need to in order to bring inflation back down to 2%. Now, one of the ways that you get inflation back down quickly is to manufacture a recession, right? That is a way that you can actually get inflation back down. And honestly, it was back in the 1980s, you can see that, we had 2 recessions, and it was those recessions that ultimately brought inflation back down to earth. If we go click on just sort of the inflation tab right here, you can see, in fact, going back to the 70s and the 80s when we had inflation at really high levels, it took recessions to bring it back down. Even over here in 1969, right? It took a recession to bring inflation back down. In 74, it took a recession to bring it back down. And in 80 and 81, it took 2 recessions to bring it back down. So, the argument today is, well, can he really manufacture a soft landing without going into a recession? And I think the main evidence that I suppose the bulls would be pointing to would simply be the unemployment rate. And the reason is because normally you don't really get that recession that we talk about, especially when you see the inversion of the 3-month and the 10-year and the 2-year and the 10-year yields. You don't really get that recession until unemployment starts to go up. Okay? And you can see unemployment, right? Eventually starts to go up. Anytime that, at least usually once the Fed gets really aggressive when their interest rate hikes, we'll see unemployment go up. And as it's going up, we have a recession, and it's during the recession that the market usually bottoms, with the exception of the 2000 to 2002 bear market. You can see it actually bottomed after the recession. But again, there were some pretty big events going on in 2001. So, I mean, I think it's understandable that we ended up putting in a new low. I mean, again, these markets are not predictable to the T by any stretch of the imagination. You always have to have some flexibility on various risk factors that could always occur. But the unemployment rate still remains low. And in fact, one of the reasons I wanted to delay the video as well was because I was waiting for this new unemployment data. And despite all of the interest rate hikes so far, the unemployment rate still remains at 3.7%, which is still somewhat historically low. Okay, I mean, the lowest it's been this business cycle is 3.5%, and we're still sitting, just off of these historic lows. And you'd have to go back decades to find, unemployment rates that were lower. And guess what? They also led into periods of high inflation. Okay, now, despite the fact that Powell reiterated a lot of the statements that he's previously said for the entire year, and despite the fact that, a lot of people like to pretend like that the Fed is pivoted, or that, we've been talking about the pivot all year, right? I don't think that this is a pivot, right? But what I will say is that out of every time I've heard Powell speak this year, I think he came across less hawkish. That might be the bearish way to say it. The more bullish way to say it is he came off more dovish than he has. Okay? Now, that's not to say that, he's about to turn the money printer back on and we're just going to start celebrating and rallies to new all-time highs. But what it is to say is that we are coming up to a point that is certainly some change in monetary policy. And namely, what that change is a slowdown or a moderation of interest rate hikes, okay? So, I've been fairly clear for the entire year that the Federal Reserve needs to front run interest rates because we need to get inflation back down. And we know that historically it takes us getting the interest rates, right? It takes us getting the Fed funds rate above inflation historically, exhibit A, B, and C, so on and so forth, to get inflation to come back down. And so, when you're looking at inflation that's at 8%, like in 9% in earlier 2022, and you have a Fed funds rate that's at like 1%, there is a huge gap to fill. Okay, a huge gap to fill. And if all they do is do 25 basis points, it's just going to take too long for us to really, close that gap. But by front loading a lot of these interest rates, which is what they said they were going to do, they've managed to get it up to 4%, before the end of the year. And my speculation for this year has basically been, for the entire year, somewhere between 4 to 5%, right? Despite the debt to GDP arguments, all that sort of stuff. The argument has always been on my side, right? 4 to 5% is where the Fed funds rate needs to be sometime by the end of this year. And the reason you might say, well, if Powell made all these quotes, or if Powell said all these things, and they sound like the exact same thing that he's always said, why then are we talking about a slightly less hawkish Powell? And it's because he said a few things, and one of those things was that, and he said this before, but let me explain. He said that they will be, they could see themselves moderating interest rate hikes as early as December, right, which is this month. And we know we have an FOMC meeting coming up here in just like a week and a half or so. So as early as that meeting, we could see a 50 basis point rate hike for the first time in a long time. Now, I've been pretty adamant every meeting, basically, that it was going to be 75 basis points. And I know a lot of people were hoping for 50 basis points at various time frames or 100 basis points, but 75 was sort of what was it was like telegraphed to everyone. The markets fairly consistently thought that, at least when you got closer to the meeting. Sometimes they didn't think 75, but because inflation continued to surprise the upside, the market came around and decided 75 was in fact the correct answer. And then that ended up being the correct answer, and that's what Powell went with, or that's what the Federal Reserve went with. But this time, the market is saying, you know what? It's only a week and a half away or so from the next interest rate hike, and the market's saying it's about almost an 80% chance of a 50 basis point rate hike. So rather than go from 4 to 4.75, markets are saying, look, they front loaded them all year. Powell is starting to seem a little less hawkish, and they've said as much that they could lower interest rates or moderate interest rate hikes is what I should say. They've said as much that they could do it as early as the December meeting. He did not come outright and say that they would do it at the December meeting. He said that they could do it as early as. But then if you listen to him later in sort of his like question and answer time period, it certainly sounded like, a lot of the members had sort of come to terms with go ahead and slowing the rate of interest rate hikes. And you might say, well, why? Right? Why would you slow the rate of interest rate hikes if we know that historically we need to see interest rates really close to inflation to really bring it down in a sustainable way? And I think the argument for that is that interest rate hikes are generally not felt immediately. And they can take up to a year potentially before they're actually felt throughout the economy, up to a year. So what the Federal Reserve is saying, what Powell is saying here is, look, we've just gone on the most aggressive rate hiking schedule that we've really ever seen. And so far, the economy is strong. We're still putting in new highs on real GDP, new all-time highs. So if that's your argument for a recession, you can't use it anymore because we're still putting in new all-time highs. And the unemployment rate is still low. So then why don't they keep going 75? Well, again, if it takes 3 to 4 quarters for the interest rate hikes to be felt, there's a lag. And they recognize that there's this lag. And so it might not seem like they've done any damage to the economy right now, but the counterpoint is that the interest rate hikes have just simply not had enough time to really affect the economy. And if you go look at these prior interest rate hikes, like if we go take a look at sort of the effective federal funds rate, you can see they didn't start increasing them until early 2022. So there's an argument to be made that the repricing of, say, like risk assets like the S&P 500 and Bitcoin or whatever, maybe not Bitcoin as much, but especially stocks and major index funds and stuff like that. There's an argument that the main repricing of them in 2022 has not been because of a recession, but it's just simply because of interest rate hikes, right? And the Federal Reserve going quicker than they've really ever gone before, and not really knowing where they're going to stop is the thing, right? Not knowing exactly how long they're going to go and how long they're going to hold the interest rate hikes or the Fed funds rate as high as they need to before inflation comes back down. But here's the thing. They've raised the rate so quickly, which I think is what they should have done. We just simply do not know the effects yet. And so now they're saying, well, rather than just continue to go 75 basis points forever, why don't we slow it down to 50 and continue to do that, and then we can slowly start to see the effects on the economy. Remember, the unemployment number is the last thing, right? I mean, this is the last thing. We're talking about recessions and whatnot, and you might say, well, why are we so convinced of a recession, or why do the charts suggest that? Well, again, if you go look at something like Treasury yield spreads, a pretty good indicator of a recession. The 3-month and the 10-year, pretty good indicator of recession. If you're not sure what this is, you just go look at the go look at the Treasury yield curve. It's inverted, right? The yield on the 3-month is giving you a higher annualized yield than you can get on the 10-year. This doesn't really make a whole lot of sense under normal market conditions, like you would see throughout the 2010s. But if you go back to before the 07 recession, again, you see the inversion of the yield curve. We're heading this direction, my friends, right? We're heading this direction. It's not there yet, right? The short end of the curve here has not elevated to those high levels like you see just before the recession that we saw back over here in 07, but it's probably going to happen soon. Why is that going to happen? What sort of evidence do we have to suggest that the short end of the curve here is going to elevate even above these levels? Well, it's somewhat straightforward. If you go over to where interest rates are likely going to be, markets are thinking about 5 to 5.25% or so within the next few meetings. So that means that the short end of the curve, like the 1 month and the 3 month, at some point soon, you should. I mean, look, it's not financial advice, but at some point soon, you should be able to get close to 5% on some of these shorter time frames. Now, it's not 5% for just holding it for 1 month. It's annualized, so remember that. But this part of the curve should go up relatively soon. Just like right over here, right? Like if you look at let's live through what happened. So here's 05, and then here's 2006. All right, now it's inverted partially, right? But here you can see the short end of the curve is still not above, the 6-month and the 1 year, even though the 3-month is getting close to inverting, some of these higher time frames. And then you see it, right? You see it completely invert, or at least for the most part, where you're getting 5% annualized for the 1 month, and then it just goes down from there. And you can see, some of these longer time frames, you're getting about 4% or so. And then what happens after this basically entire thing inverts? It then, over a period of time, it goes back to normal, right? It goes back to normal. And that is the recession, right? That's the recession. But remember, it's during the recession that the market typically bottoms. The risk is the S&P anyways. So the point is, I have no idea exactly how these counter trend rallies are going to go in the short term, right? I mean, everyone's looking at this chart right now. And I mean, I remember over here, this is the S&P 500, by the way. I remember over here, I was quite bearish. And we talked about how, look, we're coming up to the 200-day SMA. It's likely just going to be yet another lower high. And we talked about eventually going down to that 3,400 level. We have not made it to 3,400 yet. We went to 3,490, but we really didn't make it all the way down to 3,400. And now we find ourselves in a very similar position. Very similar position. And of course, the same narratives are coming out, right? Like, well, this time it's going to break, and everyone who thinks it's not is wrong. And I will say, look, there's a chance it could break, right? There's always a chance that you could see something like this. I mean, I will say this, whether you should believe it or not, if this breaks through here, it's probably going to make everyone want to FOMO in, and then we'll probably then come back down. And then you'll have to figure out if it's a higher low or if we just go and put in a new low. If we just simply get rejected again, I mean, it's just the same thing we saw back in August. I do think, whatever happens in the short term, whether we come up and do sort of like a fake out and then come down, or if we just come down straight away, I think there's a high likelihood we will be revisiting some of these lower levels at some point within the next few months, or especially once we get into 2023. So you might say, well, what is the risk for 2023? If the interest rate hikes are getting to the point where they're mostly behind us, what are the risks? Well, I will first remind you that we still have some interest rate hikes to go, okay? Now, I think a lot of people just naturally assume that we're going to go 50 and 25. The market doesn't currently think that, actually. The market currently thinks 50, and then, well, actually, I stand corrected. A few minutes ago, a few days ago, I looked at this, and the market was thinking 50 and then 50 again. Right now, it looks like it's 50, and then 25 basis points is coming in at 46.1%, and then another 50 basis points is coming in at 44.9, and an 8.9% chance of it being, all the way up to 5.25. But I don't think, the thing is like this 5.25 is probably somewhat dependent on this, on like if we get a 75 basis point rate hike in December, then and we get to 4.75, then we would go down to 50 basis points in February to get you to that 5.25. So arguably, you could say that some of this will kind of move over here. But right now, it's fairly split between 25 and 50 basis points in February, right? I think we will at least make it to 50 or to 5%, right? I think 5% minimum is where the Fed wants to go. And perhaps once they get to 5%, maybe somewhere between 5 to 5.5%, I can see them pausing for a while and seeing if it has an effect on inflation to the point where it actually brings it back down in a sustainable way. And there's an argument to be made that, what if they raise to 5 to 5.5 and they leave it there, and then inflation starts to go back up again, and they might have to keep raising, right? Like, that's a risk that perhaps is not being discussed enough. And I honestly hope that we don't have to deal with that, right? I hope that's not something we have to deal with. I would hope that inflation just comes back down. But investing is not really great if you're just constantly hoping for things. You basically just have to respond to what's actually happening in the market. So, the interest rates, to me, it seems like there's and I've been somewhat open, about what I think each month or each time we have an FOMC, and I've been thinking 75 basis points for the last 4. I would say the next one's a good chance it's going to be 50, right? The only thing I would say that might make me change my mind and go back to 75 is we have another CPI report just before the next interest rate hike. So if that surprises to the upside, headline CPI came in below 8%, core CPI came back down as well. If both of those go back up very quickly, and headline is back above 8%, and core is almost putting in new highs again, I think you make the case that the Fed can go 75 basis points one more time. Okay, I think if they're going to do 75 again, it's only going to be one more time, like at the most. I don't think they're going to do 2 more 75 basis point rate hikes. It's either going to be 0 or 1, in my opinion. So if they do the 75 basis point rate hike in December, then I think we're likely done with 75 basis point rate hikes for a long time. And then they'll scale it back. And then what will be the narrative of 2023? I hope it's not inflation. I don't think it will be inflation. I think there's a good chance inflation will come back down if we get pushed into a recession, which means if unemployment starts to go up and people's spending really starts to go back down. So then the question is what would cause risk assets in general to come back down? You know, like, I mean, even suppose there's a breakout here on the S&P 500. Suppose that happens. What would cause the S&P 500 to come back down in Q1, right? Like if we get a Santa rally that, you know, everyone's calling for. If we get a Santa rally, what would lead us to back down to these levels down here? I think the answer to that would be earnings. Okay, I mean, I think that's clearly the answer that is most obvious anyways, is that earning expectations for 2023, you could argue, remain relatively high because they're not pricing in a recession. And I think the reason they're not pricing it in is because there still is a chance, you know, whether we want to admit it or not. I think it's a relatively small chance, but a chance is a chance, right? So you're saying there's a chance. I think there's a chance anyways that the unemployment rate just somehow remains low. But I also do know, right? I mean, you look at the charts, the unemployment rate's usually the last thing to go up, right? By the time that happens, we're in the recession, and then the Fed's trying to get us out of it, okay? And by that point, you're looking at you know, all sorts of things going on in the stock market. The market can quickly move down and find a bottom, and then everyone feels it in the economy, and it feels like the stock market should keep going down, but it doesn't because it's forward-looking. So I think with regards to the unemployment rate, you know, yes, it hasn't gone up yet, but one reason it might not have gone up yet is because it takes a year for interest rate hikes to be felt throughout the economy. So if the first rate hike didn't come until early 2022, we might not fully feel it in the economy until 2023. Now, it might feel like we're feeling it in the economy because the stock market is down and crypto is down, but they might just be down because of the aggressive rate hike by the Fed. Again, the U.S. economy has remained strong. We're still putting in new highs in terms of real GDP. This is the same metric that everyone would have used to tell you we were in a recession, right? You know, if that's if this is the only metric you're going to use to say that we're in a recession, how can these people still say we're in a recession if we're not even looking at 2 consecutive quarters of negative GDP anymore? We're putting in new highs, right? Real GDP, despite the fact that there was that contraction over here in the first and second quarter of 2022, we took those levels out. The 2021 levels, like we're putting in new highs in terms of real GDP. Again, so if that's the case, how do you argue it's a recession, right? I don't think you do. I don't think you argue it's a recession right now. I don't think we're in a recession. I think the recession comes whenever the unemployment rate goes up. And once again, the inversion of the yield curve and the spreads are predicting that we will see a recession. Now, I've been fairly clear that I think the recession will come in 2023. There's a risk that it doesn't, and it might, you know, it could take until early 2024 or something. It just depends on how strong the economy is and how resilient it is and how strong, you know, consumer spending just continues. And I mean, I think the way that could happen is like if the Fed, you know, gets to a point, it pauses, and then inflation starts to go back up, and then the Fed has to raise rates again or something, and then maybe there's just some lag effect or something. But if you look at prior inversions of the 3-month and the 10-year, for instance, back over here, it inverted in like the summer of 2000. We were in a recession by the first quarter of the following year. So about 6 months later. We've inverted here in October. So that could easily suggest that by the second or third quarter of next year, we're looking at a recession. This inversion occurred in July of '06, so 2006, summer of 2006. The recession didn't come until about 17 months later or something like that. So that I guess would be the piece of evidence that suggests that it could be further out. But again, there's something about this rate hike that is different than what we saw the last two times, because the last two times that interest rates were going up, it actually corresponded to the stock market also going up, right? Like, so if you look here, the Fed was raising rates, the market was going up, right? The Fed was raising rates over here, the market was going up. Now they're raising rates, the market's been going down. So it's somewhat, you can't even compare them exactly anyways, because normally the Fed is a bit more on top of things and raising rates when the economy is strong and not waiting until things get really bad to start raising them. But here we are. Right, here we are. So, we'll continue to watch the S&P 500 relatively closely. Again, my general expectations, to just be honest, I think we're either going to get rejected here, or we'll see some type of like a FOMO move higher and sort of a fake out, and then we come back down. I don't know. I don't really know which one it's going to be. I do see sort of the same narratives yet again, that like, oh, well, everyone's watching the trend line, therefore it's going to break to the upside. A lot of people were saying that back in August as well, right? And, here we are. It's like with Bitcoin, we spent the entire summer listening to people say, well, everyone's so bearish, that means it's got to go up. And we still put in a new low, So these things that people say, they say them, they don't really mean a damn thing, because, at the end of the day, they'll just say the same thing next time, even if they're proven wrong. Like, you're going to see the same thing no matter how low we go. No matter how low Bitcoin goes or how low the stock market goes, there's always going to be those comments of, well, everyone's bearish, so therefore the market's going to go up. I didn't live through a lot of these prior bear markets because I was just too young to really know what was going on. But I look at what happened in during the dot-com crash. I have to imagine that literally like every step of the way, there was probably someone out there saying, well, everyone's watching it, therefore it must go down. And if you look at the structural bear market of say the S&P 500, this bear market that we had back over here, you can see we had, I didn't even line this up really that well, but, and also this is on a log scale too, so, it might not be exactly what you might have on your screen, but, we had plenty of lower highs. And then finally, we had a pullback, and then we had a fake out, right? We had a fake out, and then it just ended up being a double top. And then we still came back down and put in a lower low. So that's why I'm saying, like, even if we get a move higher past the trend line, it still could simply just be a fake out. And then we have to deal with earnings in 2023 that I think is going to be the major headwind. By the time we get out to 2024, I think a lot of this stuff is going to be resolved, and we should be going back into a bull market by that time, is my general expectation. I still think 2023 is going to be choppy at best, so we have a lot of work. I think the markets have a lot of work cut out for them over the next 12 months. But anyways, I think we're going to wrap it up there. I know I've been rambling for a long time. I'm sure you guys are ready for this to be done. So again, make sure you subscribe. If you're not subscribed, give the video a thumbs up. We also do have Into the Cryptoverse Premium at intothecryptoverse.com. And I'll see you guys next time. Bye.